Hi everyone. Welcome to Pranav's Trading Insights, where I share my tips and tricks on how to trade smart and profitably. In this video, I'm going to talk about one of the most popular and useful technical indicators in trading, the moving average. What is a moving average? A moving average is a line that shows the average price of an asset over a certain period of time. It smooths out the price by removing fluctuations and noise, and helps us to see the overall trend and direction of the market. There are 4 types of moving averages. Simple moving average, SMAE. This is the most basic type of moving average. It calculates the average price by adding up the closing prices of each period and dividing by the number of periods. For example, a 10-day SMAE adds up the closing prices of the last 10 days and divides by 10. Exponential moving average, EMA. This is a more advanced type of moving average. It gives more weight to the recent prices and less weight to the older prices. This makes it more responsive and faster to catch the trend changes. For example, a 10-day EMA gives more importance to the closing price of today than the closing price of 10 days ago. Linear weighted moving average, LOMA. This is another type of moving average that assigns different weights to each price. The weights are linearly distributed, meaning that the most recent price has the highest weight and the oldest price has the lowest weight. For example, a 10-day LUMA gives 10 times more weight to the closing price of today than the closing price of 10 days ago. Weighted moving average, ME. For example, a 10-day WUMA gives more weight to the recent prices than a 10-day LUMA, but less weight than a 10-day EMA. How to use moving averages in trading. Moving averages can be used for various purposes in trading, such as identifying the trend. A simple way to determine the trend is to look at the slope and position of the moving average. If the moving average is rising and above the price, it indicates an uptrend. If the moving average is falling and below the price, it indicates a downtrend. If the moving average is flat and close to the price, it indicates a sideways market. Finding support and resistance. A moving average can also act as a dynamic support or resistance level for the price. When the price is in an uptrend, it tends to bounce off the moving average as a support. When the price is in a downtrend, it tends to face resistance from the moving average. For example, if we use a 50-day EMA, we can see that when the price is above it, it often finds support from it and continues to rise. When the price is below it, it often faces resistance from it and continues to fall, generating trading signals. A moving average can also be used to generate buy or sell signals based on its crossover with another moving average or with the price. For example, if we use 2 EMAs with different periods, such as a 21-day EMA, green, and a 42-day EMA, read, we can see that when they cross each other, they indicate a change in trend direction. A bullish crossover occurs when the shorter EMA crosses above the longer EMA, signaling a buy opportunity. A bearish crossover occurs when the shorter EMA crosses below the longer EMA, signaling a sell opportunity. What are some best practices for using moving averages? Moving averages are very versatile and can be used in different ways depending on your trading style and objectives. However, there are some general guidelines that can help you use them more effectively. Choose an appropriate period. The period of your moving average determines how smooth or responsive it will be. A shorter period will make your moving average more sensitive to price changes, but also more prone to false signals and whipsaws. A longer period will make your moving average more stable and reliable, but also more lagging and slow to react. Therefore, you need to find a balance between accuracy and speed that suits your trading strategy and time frame. Use multiple moving averages. Using more than one moving average can help you confirm your analysis and filter out noise. For example, you can use a combination of short-term, medium-term, and long-term moving averages to identify different levels of trends and signals. However, you should not use too many moving averages, as they can clutter your chart and confuse you. Use other indicators. Moving averages are not perfect, and they have their limitations. They can lag behind the actual price movements. They can give false or late signals, and they can fail to work in choppy or sideways markets. Therefore, you should not rely on them alone, but use them in conjunction with other indicators and tools, such as trend lines, chart patterns, volume, oscillators, etc. Conclusion: moving averages are one of the most widely used and powerful technical indicators in trading. They can help you identify the trend, find support and resistance, and generate trading signals. However, they are not foolproof, and they require proper selection and interpretation. You should always use them with caution and discretion, and combine them with other methods of analysis. I hope you enjoyed this video and learned something new. If you did, please like, share, and subscribe to my channel for more trading insights. Thank you for watching.